Carnival Cruise stock is an interesting one to consider for investors because of the unprecedented circumstances during and after the pandemic. The business underwent some big changes, borrowed $20 billion dollars at very high interest rates, and now the business is recovering, generating billions in cash flow, and offers a unique opportunity. I'm going to go through all those unique situations that makes Carnival Cruise stock interesting for investors, and then I'll answer if the stock is a buy. I'll share with you my proprietary discounted cash flow valuation model, and I'll look at the valuation on a forward price to earnings and price to free cash flow basis. And I'll share with you how the business is doing better now than it was before the pandemic. And that's surprising to me. So we'll go through all of those unique situations with Carnival. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So I mentioned how the business is better than it was before the pandemic, and you can see that in the revenue. Trailing 12-month revenue at $25 billion is up from the pre-pandemic level of around $18-19 billion on a trailing 12-month basis. And what's also more impressive is that Carnival is generating that kind of revenue and generating more revenue from each person. Carnival has raised prices considerably, and the inflationary surge has been helpful for Carnival because its assets, the cruise ships, are now generating more value. So those decades old, sometimes assets, are now more valuable to the company. And it's valuable in a way that's difficult for competitors to replicate, right? Building a new cruise ship and sending it out into the ocean is a difficult, very capital intensive endeavor where few businesses would try this, especially because not only do you need a lot of capital, but then you need the expertise. And so you don't have too much competition in this space. And it's difficult for new entrants to come into this space. And because of those unique factors, Carnival has a nice competitive advantage or a moat, if you will. Some people like to call it that because that's what Warren Buffett calls it, when your business is protected from others trying to come in and take away your customers, right? That's similar to what Carnival Corporation has because of those factors. And if you look at the company's operating profit margin on a trailing 12-month period, it's been consistently positive now for a little over a year, following, of course, the devastations during the pandemic when it was losing billions of dollars because it was forced to stop operating completely. And it's recovered from that. And that's not an easy thing to do. And when you have a company that's went through something dramatically negative like that, through no fault of its own, but going through something like that and operating, navigating the business, if you will, through those difficult waters, if you don't mind the comparisons, it adds value to the company's management team because now you have a management team with experience dealing with unprecedented circumstances, unprecedented in a negative way, circumstances, and coming out of that stronger than before. And so now you can be a little more confident with this management team because this management team has went through something, learned from it, and now they're more experienced. The returns on investor capital are also solid at 5%, but you can see them recovering from these lows. And I wouldn't be surprised if these improve up closer to 15-20% over these next couple of years because they primarily have their capital base already established with the cruise ships. So they're not putting out very much new capital. The company's not right now thinking about adding new ships, adding new capital to the base. They're more focused on generating that business that they lost during the pandemic, reaching out to customers that perhaps paused or delayed trips and getting them back on board and generating more revenue from each available cabin or room whatever you want to call it, and thereby harvesting those capital assets that they've already built. And so that's going to generate solid returns on investor capital without fearing that the company's going to miss out on revenue opportunity, because that's what the whole industry is doing. The whole industry is trying to recover, and they're not adding very much new capital, new ships, and they're just trying to harvest existing ships and make as much as they can from the available space on existing ships. And that's good news industry wide. So I wanted to share with you my discounted cash flow for Carnival Corporation. And there's a couple of interesting things to note. So my intrinsic value per share, first of all, is $26, and the current market price is $21. So it looks undervalued according to my DCF. Another thing to note is that the cost of capital that I have for Carnival is 13%, which I think is higher than it might be next year and the year after that and the year after that. And the reason for that is this company's stock has a beta of 2.67, because the beta measures the riskiness of the business going back 5 years. And of course, that still includes the years following the pandemic when the business was extremely volatile, extremely risky. And in the next 5 years, while there are risks that remain, those risks are slowly going to decrease going forward, so long as they continue executing and the business looks like it's on track to do that. It looks like it's on track to do really well in terms of generating cash flow. As you see here, the analyst on Wall Street forecast a nice increase in cash flow. Another thing to note, they have total debt of $30 billion. And I mentioned 20 billion out of that 30 billion was undertaken during the worst of the pandemic. So these are high interest debt. But you see the company's generating very strong cash flow, $3, $4, $5 billion in free cash flow expected. So, and they've already begun to do this. Management is paying down this long-term debt. And as they pay down the long-term debt, it lowers their interest expense, which allows them to generate more free cash flow, which they can use to pay down more debt, which then makes the business less risky, and on and on. That positive virtuous cycle has maybe 5 to 10 years to play itself out, because 30 billion, $20 billion was a lot of debt. And they are likely to take 5, 10 years maybe to bring down the highest interest debt, the highest interest components of that $20 billion in debt. So this can play out for several years for Carnival, and it makes an interesting investment. So, and then when we look at valuation on the forward price to earnings and price to free cash flow, the forward PE at 10 looks undervalued. The price to free cash flow at 21 looks fairly valued. So 2 out of the 3 metrics I've looked at, Carnival stock looks undervalued, with some unique opportunities, some unique catalysts to increase free cash flow, to decrease risk, and therefore increase valuation. So to answer the question, is Carnival stock a buy? I say yes. I rated it as a buy, and I updated that recommendation on March 19th. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.